All right, well, I hope everybody had a great Christmas holiday here over the weekend and a great weekend. Market came back, but really not a whole lot of movement today. Big move in Apple, big move in crude oil, so I'm going to break down some of those moves. But if we end up with a day like today tomorrow, let's take the day off tomorrow in terms of another video. Spend this time with family and friends. I'll do the same, and we'll come back on Thursday and kind of do a weekend review, year in review, one more video for the week. Before we take the weekend off for the New Year's holiday. So light day today. I'll break it down. I'll break some technical patterns I'm seeing down, but not really a whole lot to cover. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Tuesday, December the 26th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel down below. You can do it while you're watching right now. Just hit that red subscribe button right below the video. Also, hit that thumbs up icon right next to the video. That lets me know that you liked the video today, that you want me to do it again tomorrow. So go ahead and click that icon there. Scroll down further and comment on anything that stands out to you on the video. Use those links in the description to join the Facebook group, to like today's tweet, Market Outlook tweet, or Facebook post. Also to subscribe to my daily email newsletter. Remember, you'll see my Twitter handle on the screen up here. Follow me for more content in addition to these videos throughout the week at DavidSettle42. All right, so let's break out the market forecast indicator with the S&P 500, and you can see, again, small day today. Not surprising, right? The week in between Christmas and New Year's, those business days, again, there's that Santa Claus rally effect that's expected to be bullish, but I mean, there's not a lot, and barring any unexpected news events like, the fiscal cliff a few years back, or whatever the case is, by the end of the year, there's just not a lot of movement. Everybody's off for vacation, and people are taking time off, and a lot of the market's taking time off. And the near-term line's below 50 for the fourth day now. But again, I mean, look at the near-term rally here. So here's the peak, the last one to its peak, and you can see we're still trading above the 38% Fibonacci retracement, and the old near-term high is at the 62% Fibonacci retracement. And so don't put a lot of stock. I mean, there's an intermediate confirmation signal again, an oversold momentum line with an overbought intermediate line. That combination is a bullish signal. It's basically like a buy the dip signal, especially when you have the near-term line below between 20 and 50. But like we mentioned before over here, I wouldn't. That's not the biggest buy signal, because we're not expecting a big bounce here because we're simply going on 4 months. I mean, look how long the intermediate line has been above 50. We crossed above 50 at the end of August. So this rally we've had since then has been, very long. And you can see we're starting to get a lot more ovals. That tends to happen at the end of intermediate runs. Doesn't mean we have to go down. We've got a long ways to go down before we hit any kind of Fibonacci retracement. You can see there's going to be some support easily below 2,600 at the 38% Fibonacci retracement. So, any kind of pullback like that might seem bearish, but it won't be. And even then, considering how bullish market sentiment is right now, you're probably going to be stuck more in this area here between 26.25 and above, and you'll see that that's kind of like the 4-week range. So don't buy, like in a week like this week when volume's really low. Don't put a lot of stock into any signals you get on a slow week, or a Friday after Thanksgiving, whatever day or week, when it's around a holiday and it's really low volume. There's just not a lot of stock you can put into that. We're still consolidating on a short-term basis on the Dow. You can see the NASDAQ was a little bit more bearish, with Apple having a bigger effect here, but still not bearish enough to bring the intermediate line out of the upper reversal zone and to change any kind of the posture. And you can see the near term, the small cap stock, which doesn't have that Apple effect, didn't drop down at all hardly, and it's still kind of hovering around its 52-week high. So and I've always told you, and remember this, markets don't tank or turn into bear markets from all-time highs. They will always roll over first and start a bearish intermediate trend. You don't go from strong bullish postures to strong bearish postures overnight. Right? You go from strong bullish postures to weak bearish postures, and those weak bearish trends build into stronger ones, and those shorter intermediate bearish trends turn into a bigger intermediate trend eventually. But it doesn't happen overnight. So we'll see that, and we'll talk about that, and you'll know it. And when the market is as it is now, the strong bullish trend's intact, and we can trade that trend, but we just have to account for the fact that we've been bullish, that we've had such a strong return this year, that we've had such a strong 10-year average return to get to this point. That expected returns going forward, especially for your longer-term investors, aren't going to be as high from today going forward over the next 10 years. And so we have to adjust how we trade and what kind of portfolios and our expectations for that effect. Yeah, let's say that your average returns is 3 to 4%, or expected average returns are 3 to 4% over the next 10 years because of how strong we've been over the past 10 years. Well, that doesn't mean that every single year is going to be a 3 or 4% return. You're going to have some 20, 30% returns. You're going to have a 30% drop one year. And usually it's only 1 year that you have a big drop. Right? You might have a little small one here or there. But that one big drop is what impacts the average returns over a longer period of time. And so what we want to do is try to avoid eating up all that big drop in that given year, because we'll see it. We'll see it coming. We'll know it. We can rotate into safe havens. We can manage our portfolio, and we can start managing that portfolio now so that, instead of losing a 30% or 20% in a given year, we only lose 5%. And by doing so, your average returns won't be nearly as impacted as somebody who's, say, 401ks or whatever are just matching the market, and they end up taking the 30% drawdown, which impacts those average returns they get over the next 7, 8 years or whatever to fulfill that 10-year period. So you kind of get my idea that we still can be bullish, but we manage according to expectations. And those expectations are based off what we've seen, right? And past performance doesn't predict future success, but it does give us an expectation. And it's not what you think. Just because we've had strong performance doesn't mean we should expect strong performance. And usually it's the other way around. We've had strong performance, we expect not so strong. It doesn't have to be bearish, but it's not as strong. If we have really bad performance, then we expect really good performance going forward, and that can impact how. So right now we've had really good performance, and so we don't expect the same thing going forward, and we're going to manage accordingly. Today's action looks like a speck on the long-term chart. So again, just kind of puts the context in that, small moves like this, weak volume moves, don't put a lot of stock into these. Still a strong long-term trend here going on. We look at 3 green arrows charts. We have a red arrow on the MACD. The MACD is below its moving average. We talked about when it gets this high and starts to crosses below its moving average like it did, we typically drop down to an intermediate low point, and that's this peak that we got to, this line. See, we didn't quite get to that here, and if you look over the last couple of years, you can see all the other times we eclipsed this line, and the MACD crossed below its moving average, we drop to a new intermediate low point. So don't be surprised if we don't get a new intermediate low point. And you can see there's divergences setting up with the stochastics also crossing below its moving average. But again, don't read more into that. We don't have to transition to be completely bearish. It's a normal, I know the market doesn't seem like it does have normal pullbacks anymore, but that's the way it works. And the fact that we've had 4 months, that's abnormal. This is abnormal. It's more normal, you can see, to get a orange oval, which is an intermediate low point every few months, essentially. So that's more abnormal, and because it's more abnormal, don't be surprised if we don't get all the way down to this 38% Fibonacci retracement during this, where the next orange oval will be. And we take a look here at the intraday chart, and you can see how, again, today's range was so small, half a point, stuck inside of the bottom end of last week's range, but still easily stuck within the upper half. Look how high we are to the 4-week range. So that's not bearish at all. And then you look at, the range, like I said, half a point of a range. There we go. And you look at the volume, 45 million. That's very, very light compared to what we've seen. Again, half a point of range. So So that puts, if it, well, not that chart right here, that puts that into, context that's really, really light and probably will be the rest of this week, barring unexpected news announcements. So it's going to be a light week, and we're going to kind of hover around the top end of this 4-week range until we get some more volume picking up here at the beginning of the year and everybody comes back from vacation. Volatility bounced up a little bit today, but keep in mind how low it is on an absolute basis. So not surprising that it's going to bounce up. It's going to hover around here. We're not expecting big moves. Otherwise, the VIX would really be taken off. But, on an absolute basis, remember we were so extremely low before the weekend, before the holiday weekend. We come back and we bounce up a little bit more too, but still very low. So, we're getting a near-term pullback. It's really nothing to worry about. In fact, this whole week, there's really not going to be a whole lot to worry about. We're going to get ups and downs. Different things are going to be in the news. Apple was in the news today. Different things are going to be in the news, but nothing trend changing. Nothing that you should build new major positions in. On a week like this week, don't do any major decisions. You can take off some risk. You can build small positions. Don't do anything. Don't do any kind of normal position sizing because this isn't a normal week. It's a really light week. It's a very inactive week, essentially. So your trading should reflect that. Everything should be small, very small, because everything is small this week. And if you do anything big and you get whipped out in a small volume move because you have a big position size, then that's going to hurt, and there's no reason for that. So keep it small, keep it smaller than normal until the volume picks back up to normal. Then you can start trading back to normal again. Of course, the biggest move that happened today from an asset class standpoint was crude oil. Crude oil took off like a rocket. And you remember, we've been talking about the last couple of weeks, we've been talking about this idea that crude oil's Bollinger Bandwidth was really low, that it was setting up for a move, a bigger move. And if we had to guess on the direction because of the trend heading into this tightening, we would guess on a breakout move to the upside. And well, today we got a breakout move in crude oil. That's a sharp move up to 60. If we were to take a look at a little bit longer term time frame on this, 60, there's going to be some resistance in this area, a little bit above 60. But we get above 60. That's, of course, it's going to start bringing in a lot of supply because you'll have a lot of U.S. drillers really liking those prices. But if we were to say, okay, let's take a look at a little bit longer term viewpoint and go out further, and we'll stay on the weekly chart. Once you get above the 60, then really there is no resistance around. There might be a little bit around 70 right there from way back here. But the reality is 80 is going to be it's going to be a target, the next real target for the upside price. So a move above 60 would be significant, and of course we've been talking about energy stocks having that opportunity for some outperformance. We had an example of it about a couple weeks ago in Halliburton. Those kind of stocks are really going to benefit. They've been beaten up. Commodity prices have been lagging and underperforming for so long. If they end up like 2007 being kind of a leader for the year, then we know that long-term bullish trend is in its late stages. From an economic standpoint, nothing really on the data today. You had a couple manufacturing surveys. Dallas was really strong. House price index, was doing pretty well. There's your year-over-year basis, the line, which is what we care about the most. Like it's starting to rise again. The economic surprise index is above 80 now. I mean, that's a very, very high level. And when we've had these high levels in the past, that's the markets hasn't been as bullish coming from these peaks. So another one of those signs that we've had a good run now, and now it's like, okay, expect some weakness, not bear market weakness, but less of a bullish trend that we've had. Don't expect that same kind of performance going forward. And then finally, you can see not a lot of data, nothing really going on today, not impacting, or this week, not really going to impact futures markets either for the Fed funds rate, which the next major meeting, significant meeting, will be here in March. So don't worry about January. It's not going to, there's 99, close to 90 some odd percent that we're going to stay where we're currently at. So there's not going to be a rate decision in January. March, though, we're above 60% for a rate hike. So pretty decent odds, high probability now that we're going to get a rate hike in March. And of course, then June, the question will be, are we going to get a second one? You can see the second one is just under 40% odds for a rate hike by June, the second one by June. So You can see economic indicators looking strong and prices rising across the board. Wages, once they start taking off, then the Fed's going to really have to be aggressive, especially with all the fiscal accommodation coming in at a time in the market and in the business cycle where it's not as necessary and can really overheat things. And so you'll see the Fed probably step in like they've done before when there's been a little bit of disconnect between fiscal and monetary accommodation. You'll see the Fed step in and say, okay, start to pull back the reins once they see indicators staying really strong, and especially when they see prices rising. Once you start picking up in wage growth, then that usually translates into higher prices across the board. And then finally, if you take a look at the sector rotation, again, this is the last couple of weeks. Energy's been the strongest, utility's been the weakest, and then that was the case today too. So with yields doing what they do, utility, of course, Apple weighed on technology. That was the biggest mover in the stock market was Apple. And again, you'll see, when the market's just really flat and not doing anything low volume, you'll see individual movers, whether it's an industry or a stock like this, but nothing, again, earth-shattering. But you can see those energy stocks and real estate stocks doing really well too, with a decent house price index rallying, among other really good indicators we've been getting in the real estate market. Everything else kind of flat. Financials were down a little bit, but nothing, again, very, very small when you look at it in relative terms. But weakness in utilities, strength in energy, and the more energy and materials continues to rally. In fact, considering the infrastructure opportunities there will be in 2018 with new infrastructure bills, and considering that commodity prices have been lagging for the last so many years, those are a couple of sectors that I think, now whether I'm right or wrong, who knows, right? Because the market will just do what it does. But based on what I've seen, I would fully expect those two sectors in particular to be, as well as industrials, to be outperformers heading into 2018. And if that's the case, again, if those are your outperformers 2018, then we know we are in the late stages of this economic expansion / bull market. So one of the things I like to do on these kind of light volume days is take advantage of the bigger movers that may have moved too much. Now in this case, what we'll do now, there might be something to this Apple story. So what we'll do is we'll do a bearish trade, but get a very high probability in case this was too much and we bounce right off and we still get a gain. So how can we do that? Well, what we'll do is we'll take a look at building here a bearish vertical. So we will sell the 165, which is at that 30-40 delta area, and we'll buy the 47. So we're buying a put in case it's bearish, right? We'll buy a put. It's a big breakout, but we'll cover out of that $6. We'll cover 380 by selling that put here. And so basically, we set a target at 165. That's where we want it to get to. And if it gets down there or anywhere below, then I get to make $5 minus whatever this costs me. But how about we cover that cost too by selling another put? Because again, we're not too sure that this move was too bearish. So I'm adding on a bearish trade, and I'm going to cover the cost of that bearish trade with a bullish trade by selling a put. Now the way that looks, if you put it on the Analyze tab here, is it looks like, again, we still want it to go down to 165, and if it breaks down here, 165, there's going to be some support. There's an old high point in this area, and there's some Fibonacci support in this area too. So, there'll be some support in here. But if it goes up, then I make $180, which ends up being more than a 5% gain on the margin. In this example, in the paper money account, the margin required to make this trade, because the cost of the debit spread is $200. So the most of this margin is for selling the put. So that's what we have to put the money in for selling that put. So it's $3,000. So 10% of that, $300, 5%, 150. So I can get now I'll have to play around with what we get here, but I can get better than 5% gain on this trade with an 80% chance of making money. And you can see where my break even. There's my break even on the trade. So it would have to really tank and break below all that support that's going to be in this 160 area. And if it comes down and just kind of hovers in this area here, then great. At that particular case, I get to make here. I have to bring this back up and we'll analyze that again. If that ends up being the case, then I'll make over 500 bucks on that 3,000. So pretty decent return if it does go down. And if it doesn't go down and bounces, I still make a high probability return for about a more than a 5% move over the next, until February expiration. So, locks up 3,000 bucks per contract, but gives me the potential for a decent reward with a high probability if it pulls back, but still a decent, kind of like almost like a dividend payment, so to speak, but decent return if it keeps going up. So, so what's my risk on this trade? Well, the risk is it really tanks. And if it really tanks, again, I got that short put. There's no cap to my losses over here. So that's what we have to watch. If it breaks 160, you can see right now if it breaks 160, I'll lose 400 bucks. But again, if it's going to be dropping, my reward is going to be about, well, in this case, 600 bucks. More than 600 bucks, about 670. So that's kind of like, I want to watch to see what's my loss going to be compared to that reward right there. Knowing that if it goes up, no matter how far it goes up, I get that credit because it's a credit spread. I'll get, because I got when I'm selling the 165 put, it covers the cost of the bearish trade. So more than covers the cost. So that's why I'm getting a credit up here, because that's a bullish trade, the 165 put that I'm selling. But if it keeps going down, because I got that bearish spread, then I get that reward added into that 165 put. We break 165. Now I start losing money on that short put to offset some of what I make on that bearish debit spread. And then if it gets past that point, now I'm losing more money on the bearish put, and that's at expiration. So this purple line will be on any day, and as long as you can see, I got time decay always working in my favor. When I go down, I'll have a positive theta, so I'll always have time decay working in my favor. But I'll just have to keep an eye on that P&L and how it compares to the potential reward that I'm going to get at that 165 level to determine, the risk, the worst case scenario, and how far I let it keep going down. Because if it breaks 160 and keeps going down, then that's a pretty good chance we're not going to get back up to that 165 area. We'll take whatever small loss that we get. If we bounce up from here, worst case scenario, takes off to the upside, okay, right? I'll get a 5% return on that for that 3,000 buck margin requirement, because I'll have to set that money aside. I won't be able to use it for anything else, but I get a pretty decent return on that over a small period of time. So thanks for watching today. Remember, I'm going to be taking tomorrow off, so no video tomorrow. I'll be back on a video on Thursday, again, barring any kind of catastrophe tomorrow. But if we get a day tomorrow like today, then everyone should just spend some time with family. I'll spend some time with family myself. We'll be back on Thursday. We'll do kind of a weekend, a year in review type video for Thursday that will also most likely cover Friday's video too. So remember to subscribe, like, and comment on the YouTube video down below. Follow me on Twitter if you haven't already. Also join that Market Outlook Facebook group with the link down in the description. Have a great evening. Have a great week if I don't talk to you again, or if you don't listen to me again because you're spending time with family or friends or whatever you're doing, holidaying this week. Have a great one. We'll see you all next time.